Every single day, billions of shares are traded on the New York Stock Exchange alone. Yet, with more than 43,000 companies listed across exchanges worldwide, how do investors determine which shares to purchase? To answer this, it helps to first grasp what stocks really are and what both individuals and institutions aim to accomplish when investing. A stock represents a fraction of ownership in a business. When someone buys a stock, they acquire a stake in that company's potential success or failure, measured through its profits. The value of a stock is shaped by the balance of buyers and sellers. When demand outweighs supply, prices rise, and when sellers dominate, prices fall. Thus, the trading price of a share reflects what market participants collectively believe the stock, and by extension, the business, is worth. As a result, prices can shift dramatically depending on whether investors expect future profitability, even if current earnings are low or negative. The primary objective of investing in stocks is to earn a profit as values increase over time. For some, the goal is simply to protect and grow wealth faster than inflation erodes its purchasing power. Others are driven by the ambition of outperforming the market, which means generating higher returns than the overall performance of all traded stocks combined. This idea of beating the market is highly contested. So much so that investors are often divided into two camps. Active investors argue it is possible to outperform by carefully selecting stocks and timing trades, whereas passive investors argue consistent outperformance is unlikely and therefore avoid stock picking. The concept of beating the market usually refers to returns greater than the Standard & Poor's 500 index. The S&P 500 tracks the performance of 500 of the largest U.S. companies weighted by market capitalization, which means businesses with higher valuations influence the index more strongly. Again, market value reflects investor perception of worth rather than actual earnings. Though the S&P 500 doesn't capture the entire market, smaller and mid-sized companies often move differently. It is still widely regarded as a solid indicator of the general market's direction. There is an old saying, "In the short term, the market acts like a voting machine, but in the long term, like a weighing machine." In other words, short-term swings are driven by sentiment, while over longer periods, prices tend to align with real profitability. Active investors aim to take advantage of the short-term voting machine side of markets. They believe inefficiencies exist. Some companies may be overpriced, others undervalued, or important developments overlooked. By finding these gaps, active investors try to profit by purchasing what they see as underpriced stocks. To identify such opportunities, they may study a company's operations, examine financial statements, follow price patterns, or even rely on algorithms. Passive investors, on the other hand, trust the market's long-term weighing machine character. They believe short-term inefficiencies even out, so by holding a broad basket of stocks representing the market, the portfolio will steadily appreciate. This approach is most often implemented through index funds, which are collections of stocks designed to mirror a market index. The S&P 500 is just one of many such benchmarks. The aim of all index funds is the same: hold broadly, hold long-term, and ignore daily volatility. In the end, active and passive investing are not strictly opposites. Many investors blend the two, perhaps choosing specific stocks, but keeping them long-term as passive strategies suggest. Investing is far from an exact science. If one perfect formula existed, everyone would already be using it.